Commodities have long been thought of as a great way to hedge against inflation, but that may no longer be the full story. We want to dive into that. We have Malcolm Dorson joining me here today. Malcolm, it's great to see you.
Thanks, happy to be here.
So let's talk about commodities because it's long associated with an inflation hedge. Does that still hold, or how should investors approach commodities today?
Well, it definitely holds, and I think it's a vital part for keeping commodities within your allocation. I mean, in 70% of the years where CPI has accelerated, commodities have gained. And in addition to that, I think there's a lot of uncertainty in terms of the direction of the strength of the US dollar these days. But on top of that, today there's a longer-term structural theme where commodities offer you a diversified play on artificial intelligence, on power, on electrification, and more.
Malcolm, you talk about it being a long-term structural theme. As we compare it to past cycles, how does it stack up?
Well, I think that's the key word, cycles. This is less about it being a cyclical play. It's not a tactical trade. It's a long-term core investment. So you are getting this fantastic long-term demand story from these new drivers of growth as we enter this age of automation, and that is meeting a shortfall in supply. So we've been underinvesting for more than a decade, and it's creating a very attractive supply-demand dynamic.
When you add all this up then, what does that mean for portfolio implementation and maybe how investors should be approaching that side of the story?
Well, I think historically a lot of people have said, okay, why now commodities and which commodities should I be in? And it's not why now as a question anymore. It has historically proven to improve risk-adjusted returns. It is a fantastic diversifier. It's an inflation hedge, a US dollar hedge, and now it's setting up with an attractive supply-demand dynamic to offer you growth as well.